If you've ever felt like you're not making financial progress quite as quickly as you'd like, you're going to be relieved to hear that progress accelerates and picks up speed. So much so that you're going to be amazed at how quickly your wealth begins to accumulate. The snowball effect, akin to a snowball rolling down a hill and gaining size and momentum, can really accelerate wealth growth over time. As average people progress on their financial journey of building wealth and pursuing financial independence, they create a compounding effect, resulting in exponential wealth growth. This is amazing news for anyone who feels like they're not quite making enough progress. Take a look at the key factors that drive the snowball effect of wealth accumulation and why you should expect exponentially more financial progress each year going forward. In many cases, an individual's income rises as they make progress with their career, and a rising income can act as a powerful accelerator in growing wealth more quickly. When you're just beginning your career, compensation is typically entry level and quite low. As a result, the entire paycheck is often used for necessities like rent, food, clothing, and transportation. As earnings increase, you have the potential to allocate a much larger portion of your income towards savings and investments. In other words, disposable income is much higher. These increased earnings allow individuals to save more substantial amounts, enabling them to build up their wealth at a faster rate. With a growing income, individuals can take advantage of more significant investment opportunities and pursue higher yield assets that carry more risk. This increased investment capacity, coupled with the potential for larger returns, can boost the rate of wealth accumulation. Additionally, a rising income can provide individuals with the means to pay off debts more quickly, reducing interest payments and freeing up more funds for investments. Careful spending plays a pivotal role in accelerating wealth accumulation, but smart spending takes practice and is sometimes challenging for those who have never done so. When individuals develop smart spending habits, they're better equipped to manage their finances efficiently and optimize their savings potential. By distinguishing between needs and wants and prioritizing essential expenses, they can free up more resources to allocate towards savings and investments. Careful spending also involves being mindful of unnecessary expenditures and finding cost-effective alternatives without compromising quality or comfort. Careful spending helps to cultivate a mindset of financial responsibility, promoting the habit of consistently saving and investing rather than indulging in impulse purchases. In addition, learning where to splurge and where to cut back will result in more satisfaction from each dollar spent. This disciplined approach to spending sets the stage for faster wealth accumulation, paving the way to long-term financial stability and success. Learning to be financially literate is a key driver in achieving faster wealth growth. Financial literacy equips individuals with the knowledge and skills needed to make informed decisions about money management, budgeting, investing, and debt management. With a solid understanding of these important concepts, individuals can identify opportunities to optimize their finances, such as minimizing unnecessary expenses, maximizing savings, and reducing debt. Figuring out what works and what doesn't leads to greater success. By being aware of various investment vehicles and understanding risk and reward trade-offs, financially literate individuals can capitalize on opportunities that have the potential for higher returns. Financial literacy encourages long-term financial planning, setting clear goals, and staying focused on achieving them. As a result, individuals are more disciplined in their financial habits, avoiding impulsive choices that may impede wealth growth. In essence, the knowledge gained through financial literacy becomes a powerful tool that accelerates wealth accumulation and paves the way to a financially bright future. In many cases, owning a home has a huge effect on wealth accumulation over time. Homeowners are statistically much better off financially due to many reasons. One of the primary ways homeowners build wealth is through property appreciation. Over time, real estate values tend to increase, allowing homeowners to benefit from capital appreciation. The home's appreciation provides an unparalleled return on investment when utilizing leverage through a mortgage. In this simplified example, let's say you purchase a $400,000 home with a 10% down payment, or $40,000. If the home appreciates 3% in 1 year, that's a $12,000 increase, or 30% return on your down payment. As the home's value rises, it creates equity that can be tapped into through refinancing or selling the property. Additionally, owning a home enables individuals to build equity through mortgage payments. As the homeowner pays down the mortgage principal, their ownership stake in the property increases. This equity can be leveraged for other investments, used to finance business opportunities, or simply saved for future financial needs. Expanding on the potential benefits of owning a home, homeownership provides stability and security as it eliminates the uncertainty of fluctuating rents. Generally, homeownership translates to stable housing costs, providing individuals with a sense of financial security and predictability, which in turn will allow you to build wealth much more quickly as time passes. Unlike renting, where landlords might increase the rent at the end of each lease term, homeowners with fixed-rate mortgages have consistent monthly mortgage payments for the duration of the loan. This stability allows homeowners to budget more effectively, as they know exactly how much they need to allocate for housing costs each month, with the exception of repairs. Additionally, while property taxes and insurance might vary slightly, they tend to change gradually, giving homeowners a better ability to plan and manage their finances. Moreover, as inflation increases the cost of living over time, homeownership can act as a hedge against rising housing expenses since mortgage payments remain constant in nominal terms. Ultimately, stable housing costs through homeownership provide individuals and families with a level of financial certainty and peace of mind. When housing costs remain stable and only increase slightly year after year, this results in more disposable income, further contributing to snowballing wealth. As people become older and more established in their life circumstances, they're more likely to be married, which can be incredibly beneficial when it comes to building wealth. Having a like-minded spouse can be a crucial catalyst in accelerating wealth and achieving long-term financial success. When both partners share similar financial values, goals, and strategies, they can effectively collaborate as a team, working towards a common vision. Their shared commitment can lead to disciplined savings, smart investment decisions, and the ability to avoid unnecessary expenses. The combined efforts of both spouses amplify their capacity to earn, invest, and capitalize on opportunities for growth. With mutual support and encouragement, they inspire each other to stay focused on financial objectives, even during challenging times. As their wealth grows, they can leverage their joint resources to make more substantial investments and explore ventures with higher potential returns. Ultimately, the synergy of a like-minded spouse fuels the snowball effect, accelerating wealth accumulation and paving the way for a prosperous financial future. One of the most prominent factors that contribute to the snowball effect of wealth is compound interest. As money is invested and earns interest, the resulting returns are reinvested, generating even more interest in the subsequent period. Over time, this compounding effect results in exponential growth, as the interest on both the initial investment and the accumulated interest continues to compound. The longer the money remains invested, the more pronounced the impact of compound interest becomes, and the interest becomes much more significant. With each compounding period, the wealth grows at an increasing rate, leading to significant growth over time. For example, an individual who has $10,000 invested and earns a 10% return on their investment will realize a gain of $1,000. When they have $100,000 invested, a 10% return equates to a $10,000 gain and a $100,000 gain on a $1 million investment. After several years or decades, this compounding effect becomes so powerful that the growth is mind-blowing. The snowball effect of wealth growth over time is a testament to the power of compounding, strategic investments, and continuous learning. Compound interest, financial literacy, entering the real estate market, and career advancement are all essential elements that contribute to faster wealth growth. When combining some or all of these factors, you're going to be absolutely amazed at how fast wealth begins to snowball.